The next method is gross profit method. And this method is mainly for estimates of inventory. It is not for financial reporting. The following are scenarios when we need to estimate the inventory balance. The idea of this method is very simple. Remember, we have this equation. The beginning balance of inventory plus the purchase, that's goods available for sale. And these goods available for sale are either sold as the cost of goods sold or unsold as ending balance of inventory. So now we need to estimate the ending balance of inventory. We just change the position of these two variables. Basically, this value is available from accounting records. We just need to determine what's the cost of goods sold. So basically, we estimate the cost of goods sold and then subtract it from goods available for sale. We get the estimate ending balance of inventory. How to estimate cost of goods sold? That's why we name it gross profit methods. Basically, we just use expected revenue subtract the gross profit. The difference is cost of goods sold. Remember, in the income statement, we subtract cost of goods sold from revenue to have this gross profit. So here it shows us the procedures for gross methods. These are book value of inventory on accounting records. So the total goods available for sale was 2.1 million. The next is to estimate cost of goods sold. The cost of goods sold is the difference between estimate sales revenue and estimate gross profit. If we are given the gross profit is 40% of revenue, so gross profit will be $800,000. And we subtract from net sales, the cost of goods sold is 1.2 million. Then the difference, 900,000, is the ending balance of inventory that is estimated based on the gross profit methods. Because we use the gross profit as an element to determine cost of goods sold. But when we apply these methods for estimation, it relies on the reliability of gross profit ratio. Whether the gross profit ratio we applied is realistic. Next is we may group the inventory into pools of product with similar gross profit margin so that it will increase the accuracy of estimates. We know for companies, they may have different products, and each product may have substantial difference in their gross margin. For example, iPhone 16 Pro Max, its profit margin should be greater than iPhone 16 or iPhone RC model. The profit margin for these two are significantly different from each other. Therefore, when we use gross profit methods, it's better to group the inventory into pools which share the similar gross profit margin. Since the cost flow assumption have impact on the cost of goods sold or the gross margin. So when we apply these methods, you should know what cost flow assumption we apply. Cost flow assumptions like LIFO, FIFO. Remember, these assumptions have impact on the cost of goods sold, so it will have impact on the gross margin. So if there's suspected theft and spoilage, accounting standards require us to adjust estimate. We are asked to estimate the amount of inventory destroyed by the fire. We know the beginning balance inventory was 900,000, purchase 480, so goods available for sale is 1,380,000. since these goods are sold, so the fire has no impact on these goods. Okay, so we can use the sales subtract gross profit, which is the product of gross margin and sales, to estimate the cost of goods sold. And then the difference will be the ending balance of inventory that were destroyed in the fire. Estimated cost of goods sold, $945. Subtract from goods available for sale, the sum of these two. We can estimate the ending balance of inventory was $435,000 that were gone because of fire.